Hello, this is Kahlil Adam, head investor at Itaú Private Bank, and I would like to thank you for joining us once again for our monthly international markets update for July 2023. During last month's video, I focused primarily on the market implications of a soft versus a hard landing. To recap, a soft landing would likely lead to sustained higher equity prices, whereas a hard landing, explained by a deep recession and a pickup in unemployment, would lead to lower company earnings and lower equity prices. For the fixed income markets, as a general rule, a soft landing would result in rates remaining higher across rate curves than a hard landing, which is typically accompanied by aggressive central bank rate cuts, all else being the same. That said, economists are now largely divided when it comes to the outlook for the U.S. economy over the next 12 months. Less than 9 months ago, in October 2022, when equity markets were at their last 12-month lows, it was a near consensus call amongst economists that a recession was imminent over the ensuing year in the U.S. Currently, economists forecast the probability of a U.S. recession in the next 12 months is closer to 50%, and that number is rapidly falling. This dichotomy is also reflected in the diverging messages between the fixed income and equity markets. After rallying 6% in June, the S&P was positive again in July, closing up another 3%. The multiple on the S&P 500 is currently at 20 times next month's earnings, which is about 25% above the long-term historical average of 16 times and 10% above the last 5-year average of 18.5 times. This reflects equity markets participants' increased optimisms that we can avoid a hard landing and also sustain lower inflation. This month, the main consumer inflation indices in the U.S. came in at circa 3%. And while PMI and housing activity point to recession, the employment market remains strong and therefore consumption levels remain healthy. It is important to note that the Fed raised rates 25 basis points this month to 5.5%, which is a 22-year high, and that Fed economists are no longer amongst those that expect recession this year. Q2 GDP numbers actually surprised to the upside, coming in at 2.4% versus 1.6%, which was as expected. That said, in contrast to equity markets, the message from the U.S. Treasury curve remains one of continued caution. The curve is deeply inverted, with the spread between the 2-year and 10-year rates at minus 100 basis points, an inversion level not seen since the 1980s. And an inverted yield curve, especially a deeply inverted, usually precedes a recession, which is confirmed after the Fed starts to cut rates aggressively to restart the economy. In summary, the economic data in the U.S. is still mixed. Economists who forecast the outlook for the markets are also split, and the messages from the fixed income and equity markets confirm those diverging views, as the path forward to the U.S. economy is still uncertain. As was the case last month, our investment committee is currently neutral, developed market equities, and positioned slightly defensively in the fixed income market with a small overweight in investment-grade bonds, but neutral treasuries and high yield as we continue to look for more signs of what type of landing we are headed for. It is important to highlight that later this month, the annual Jackson Hole Symposium will be held from August 24th to the 26th, where central bankers from around the world will meet to discuss the global macroeconomic backdrop and relevant trends. We hope to get insights into what type of landing we are headed for from those meetings, and I will discuss the takeaways during next month's video. In the meantime, if you have any questions, please reach out to your banker or investor. Thank you, and see you next month.